Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've covered a lot of things this morning so far, right? We've been talking about the markets. We've been talking about bonds and the risks there. We've been talking about tax strategies, tax planning strategies when it comes to the 4 stages of retirement. And towards that end, just before the break, I was sharing with you about one of those strategies being that of what we call filling up the bracket, if you will, which is if you've got room and you're still in a 12% or 22% or whatever that bracket might be, we may want to, and let's say that's the same bracket you're going to be in when you're retired, okay? Or if you are retired, it's not going to change. Then we can look to take advantage of this to do some Roth, potentially some Roth conversions. And this can also be beneficial in a couple of other ways. So for instance, when we're filling up that bracket, it may be because we're anticipating that later you'll be in a higher bracket. Okay, and we want to take advantage of the bracket you're in today to avoid those later. And then here's how that can happen. So one thing to look at, for instance, you may have some low income years which happen to be very good for Roth conversions. So for instance, in particular, when someone's first retiring, right, their income may come down. So when you're working, an example, I was just with someone that's going to be, I think they're making about $200,000 a year, and in their scenario, they're in a higher earnings years, but their expenses, what they take to live on, is about half that. Okay, so in their situation, when they retire, they're going to be in a much lower income tax bracket, and we're going to take advantage then, not of doing Roth now. That wouldn't make sense to convert in a higher bracket when your bracket's going to go down. Right? It's for the opposite. So we wait until he retires. Now we're going to put together strategies, and we're planning on that. So we know what we're going to do in those early retirement years is we're going to do Roth conversions, and we've got it, already kind of mapped out. And when we do our reviews, we prepare and we do some other things with regard to the planning to set that up. Now in those early years, those are going to be lower income years, and we're going to have quite a bit of room to be able to do Roth conversions. Now, the strategy then becomes, so low income years, again, are good for Roth. Now, this can be other things, business owners with unusually low sales or high expenses, or you may have high medical expenses in a given year, which frees up money that could be utilized because of the deductions you're going to have. But the bigger ones we see typically are right after retirement, possibly before Social Security or around the same time, are starting to receive pensions, other distributions. Definitely, typically, before required minimum distribution. So occasionally we do get into Roth conversion strategies then as well, especially when it comes to legacy planning. So an important guiding question is, of course, what's the goal? You must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next highest tax rate. That's one goal we might have. Or whether you're trying to increase income to fill up a bracket to take advantage of that tax rate, which we talked about as well. Okay, all of these about managing our tax brackets when it comes to Roth IRAs. So what are other ways that you can manage your tax brackets? One of them, withdrawing tax-free money from life insurance policies. So if you've got, now this gets a little tricky. Please don't go cashing out life insurance policies or anything like that. That's not what this is about. What I'm talking about is some advisors, and you may have life and cash value life insurance policies that you build up with the goal of using that, getting tax advantaged income in retirement from those policies. This is one way that you can manage tax brackets, is when you control when you take that money and how much you might take. Selling, and this is one of the ones that we use quite a bit, is selling highly appreciated stock for low or no capital gain. So if we're managing your tax brackets and we manage selling off of stocks and stock mutual funds with the capital gains there in such a manner that we keep you in the lower brackets, we can zero out potentially any tax on those gains, or at the very least pay a lot less tax than we might on ordinary income tax rates. Now there's a lot of talk, and if you just watch the Democratic debate, you heard it. They're wanting to tax that. They want to, cause capital gains tax rates to be the same as ordinary income tax rates. So how long we'll have this strategy available to us, anyone's guess. What I would suggest, again, take advantage of this time that we have to, in fact, use these strategies to better position yourself and minimize your taxes. Taking distributions from your IRAs or 401ks, in particular, if you're in that lower tax rate. So sometimes, as an example, we say, well, I only need this much income, but I've still got $30,000. I could take out more than I need, right? But in this lower bracket, well, I could do, there's a Roth conversion. I take it out, I do a Roth conversion. Now I've just moved it from tax deferred, where it's going to be taxed when I take it out at ordinary income tax rates, and I move it over to tax free. So down the road, I've reduced my taxable income potentially. This can be very beneficial when it comes to when you're looking at taxes from the standpoint of these Roth conversions as an example. One of the things we're looking at is what are your required minimum distributions going to be when you reach age 70 and a half. And if those required minimum distributions are going to be of such an amount, and I see this all the time when I'm working with clients, that it's going to boost their income bracket. It's going to cause them to pay a higher tax on that income that they're taking out of those, that they're forced even, right? The IRS rules, if you don't take it out, there's a 50% penalty. So we know we have to take those required minimum distributions. So when we're taking them, if they could boost us into a higher tax bracket, how can we plan for that? Well, this is where we look to do these Roth conversions as an example. This is one advantage they can provide, is I'm moving that money out of that tax deferred IRA account or 401k, whatever it might be, over into a Roth. Now I have reduced the amount down. If I reduce the amount down far enough, I'm going to reduce, of course, my required minimum distribution amount I have to take out. And our goal is we want to reduce it to where it doesn't push us up a tax bracket. Okay, this is a very complex strategy in ways in terms of crunching the numbers, right, to make sure that we're balancing everything out, that we're not causing excess taxes in doing so that offset the benefit. So it's about finding this right balance in doing so. But it can be a very effective strategy. I use it all the time in my office with my clients. And when we're doing reviews each year, we do tax reviews as well as, of course, our financial reviews. We're always looking at, is a Roth a good idea to do, or how much do we do this year? And of course, other strategies that we employ with regard to minimizing taxes. Now, a couple of pre-retirement strategies that we're going to cover. If you have a health savings account, now these don't apply to everyone, but if you've got a health savings account, or you can use a qualified business income deduction after funding a company pension, different things you can do. A SEP IRA, this can be another way to do that. Things that if you think of your retirement accounts, make sure you're maximizing your taxable benefit here. And again, this gets into different types of strategies. If you have an HSA available to you, take advantage of that, pump that in every year, because that's going to be tax-free when you take it out if you use it for medical expenses. And that can be a nice benefit when you're in retirement to have that resource available. Another is always be thinking in terms of maximizing the benefit with regard to your 401k, 403b, 457, whatever it might be, whatever retirement account, IRAs, SEP IRAs, TSP, your thrift savings plan for you federal employees and military out there. All of these can be utilized to best effect if you understand how the tax code works. So I use the example all the time, married couple, you've got, when you factor in your standard deduction, and you're looking at that added to the 12% bracket, puts you up around 103, 104,000. So if you stay under that 100-some thousand, right, it keeps you in a 12% bracket. That's a very low bracket. Now we're going to show you how. We're going to take a break. When I come back, I want to delve into that a little bit to explain how you then plan for your contributions going into your retirement accounts, not just with the thought of how much I'm trying to save for retirement, but also with how you can minimize taxes now as well as in the future by how you contribute to your retirement accounts. All right? We'll take a break first, though. Join me here. We'll be right back on the Retirement Report.